Thank you everyone for being here with us today as we conduct a review on the St. Joseph's Place Asia Managed Portfolio Funds in Q3 this year. My name is Elson Goh, Head of Asia Portfolio Management in St. Joseph's Place, Singapore. In general, Q3 2021 has been a tough quarter for most assets. Inflation concerns, the Federal Reserve tapering on bond purchases, and the news of Evergrande has grabbed headlines in the last quarter, leading to higher market volatility, especially in September. Asia Pacific and emerging market equities have been the hardest hit over the last quarter as well. As we can see from the performance tables here, the Conservative International Growth Fund delivered a positive return of 0.2% in Sing dollar terms in Q3. The Balanced International Growth Fund delivered minus 0.1%, while the full equity portfolio, the Adventurous International Growth Fund, delivered minus 0.5% in Sing dollar terms, and that is net of all fees. It is great to see the Conservative International Growth Fund delivering positive returns in the last quarter, despite most asset classes being in the red. The negative returns from the Balanced and Adventurous funds are largely attributable to the challenging market environment in Q3 due to inflation concerns and China credit issues. The managed portfolio funds in general also have a slight overweight tilt towards the Asia Pacific region, which explains the negative returns for the quarter as well. However, when you look across the one-year time frame, the portfolios had generated very strong positive returns. Now, as we investigate the performance attribution, I will share what went well and what did not go too well within the portfolios. So firstly, what went well in the managed portfolio funds. And within the fixed income space, just to start, broadly speaking, the fixed income as an asset class has been in a challenging environment this year, with inflation concerns and monetary tightening looming. However, most of the bond funds within the portfolio, which are predominantly in the lower and medium risk portfolios, had done very well year to date. We saw negative performances from most of the fixed income funds in Q3, but year to date, funds such as corporate bond, global high yield bond, and diversified bond delivered positive returns. And this is largely attributable to their high exposure to high yield bonds within the portfolio. Just to add, strong active management from the managers also contributed to the performance. The global high yield bond has part of its mandate to be invested into emerging market debt. And with that, Chinese property developers were one of the exposures within the portfolio. However, with strong active management, the manager trimmed its position in Chinese property developers, including Evergrande, from as early as May this year. Therefore, the impact from Evergrande was minimal within the portfolio. Some of the other funds which performed well within the portfolio are the iShares Diversified Commodity Swap Fund and the iShares Dollar Tips Fund. Both of these funds have something in common, and that is they are broadly inflation-linked in general and has contributed to the performance when inflation numbers had gone up. And then on the equities front, despite the volatility in the market in Q3, funds such as Global Quality and Global Value contributed positively to the performance of the portfolio. Over the last quarter, there was a slight rotation within the equity market, and we saw this happen in the third quarter as markets grew more wary of fast-growing companies in sectors such as technology, and therefore rotating instead towards so-called value companies in sectors like banking or energy. As a result, funds such as Global Value have benefited from the rotation. And just to add, both Global Quality and Global Value are included in all of the managed portfolio funds in Singapore. We also saw great performance once again from the Emerging Markets Equity Fund, and that has contributed positively to the returns in the Balanced and Adventurous International Growth Funds. This fund had been the best performing fund for the last 2 years, and its strong performance in Q3 can be attributed to an underweight in China. Despite the underperformance from Asian equities, the Asia Pacific Fund actually held up relatively well. Within the full equity adventurous portfolio, the Japan and North American Fund contributed positively to the performance as part of the value-oriented strategies worked very well in the last quarter. Now, what did not go too well in the managed portfolio funds? In general, smaller cap stocks underperformed in Q3. The Global Smaller Companies Fund, which has a small 5% allocation in the Adventurous International Growth Fund, underperformed the broad market in the last quarter. Another fund which underperformed in the last quarter was the International Equity Fund. But just to add, this fund has a great track record, but it underperformed in the last quarter with its overweight positioning in technology and communications. Over the longer term, this fund has delivered strong risk-adjusted returns for clients and is included in all of the managed portfolio funds. This marks the end of the review of the managed portfolio funds, and I hope that it has provided you with some great insights to the portfolio and how they are doing. Have a great day ahead and take care.